Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's covered call writing question of the day. Today's question comes from Ed of Pasadena, California. Alan, I'm enjoying my membership and learning a lot from your encyclopedia, and I do have a question. Do you have any guidelines relating to the implied volatility of options and how the implied volatility relates to the best strike prices? Well, Ed, yes, implied volatility is critical to our covered call writing investment decisions. For those viewers who are not familiar with the term implied volatility, let's first give a definition. The implied volatility of an option is a forecast of the underlying stock's volatility as implied by the option's price. In other words, the higher the price, the greater the implied volatility. So an option that has a very high premium or a very high implied volatility means that the market is anticipating a large move of the underlying security, but it doesn't tell direction. It could be either up or down. So now let's take a look at the factors that should help us determine which implied volatility we would accept. And there are basically three factors. First, your overall market assessment. If you're very bullish on the market, then you're more likely to use an option with a higher implied volatility, because that would mean less risk on the downside. Second, your personal risk tolerance. If you're the type of person that can't sleep at night, if your stock's value is going way up and way down, then you probably should stay with a lower implied volatility option. And third, the chart technicals. If you have an uptrending chart with all confirming indicators, it's a very bullish chart, then you're more likely to use a higher implied volatility option, or one that has a larger premium associated with it. So those are the three factors. Now let's take a look at the target returns as it relates to the strike prices of the options. I will almost always avoid any 1 month option that generates a higher than a 7% return for an at-the-money strike. Anything higher than that will mean that it's a very high implied volatility. There's a lot of risk because the market is anticipating a big move in the underlying stock. A good example of that would be prior to an earnings report. The implied volatility of these options very high, the premium is very high, but the risk is also very high. My sweet spot for the time value of an option premium is between 2 to 4% in 1 month. Now, as far as the strike prices are concerned, that will be dictated by the factors we discussed. So if our overall market assessment is bullish, the chart technicals bullish and all confirming, and we have a decent risk tolerance, I'm more likely to use an out-of-the-money strike in addition to the 2 to 4% initial time value return. If, on the other hand, chart technicals are mixed, my market assessment is bearish or volatile, if my risk tolerance is very low, I'm more likely to go with a lower implied volatility and stick with an in-the-money strike. So, to summarize, the main factors we look at is our market assessment, the chart technicals, and our own personal risk tolerance. That will dictate the type of implied volatility that we'll use and also help guide us as to which strike price is best for us in that particular month. So Ed, thanks so much for that question. Very, very important and pertinent question. I hope all the viewers enjoyed this and benefited from it. I thank you all for watching. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.